Yeah, hello everybody. Happy Wednesday, hump day. Wait, is today Wednesday or Thursday? Oh my God, today is Thursday. The shortened week got me. I don't know if it got anybody else also, but welcome. Hopefully you can all see and hear me as well. Hello, Herbert. Always nice to see you. Um, Quick overview of the market today. Overnight, we had a huge move to the upside. S&Ps were up about 90 points. Dow futures were up almost 500 at one point. That was on the news of courts blocking the whole tariff thing. And obviously that has faded a bit, as would be expected. The administration is probably going to go to the Supreme Court, try and reverse that. So there's obviously a lot of confusion. What we've been talking about for weeks and weeks and months is that we know that we can get a news bit or a tweet or anything at any moment, especially regarding tariffs, that are going to impact the market, which is why we have to be on the ready. We have to be on our toes. Last night was a perfect example of that. So even with Nvidia, fantastic results, and that stock is up over 4%. The markets have come back a little bit. Like I said, they were up 90 points overnight for a good portion of the morning. They were up 30, 40 points. They actually dipped negative about a half hour, 45 minutes ago, just slightly. And now S&Ps are back up 22, 23 points. So, all right, everybody can hear and see me. That's great. So yesterday I asked about, give me a couple topics. One of them is, could you review naked options? So what I want to review today, and we'll do some examples live here, what are the differences between trading a naked option, trading a spread? Why do I prefer to trade spreads? Okay, well, what is a naked option, right? All naked option means is you have that option by itself. There's no hedge to it, whether that's a long or a short option. Okay, so buying is buying an option, right? What is your risk with buying a naked option? Option. Robert, you know what? I was really kind of waiting for you to make a comment. You didn't disappoint. You didn't disappoint. I love it. Hey, Kevin, what is the risk to buying a naked option? No, he doesn't, Gene. I think we've all come to enjoy that. Naked all the way, Kevin says. All right, guys. What is the risk? Exactly, Gus. The risk if you buy an option, whether it's a call or a put, the risk is what you pay. You can never lose more than that. Okay, so we know what our risk is on the buy side. Okay, now what about on the sell side? What about on the sell side? Well, that's where the big margin, the risk, the maintenance comes in. So buying is also called, or excuse me, buying. Selling an option is also called writing it. Like literally, I'm writing you an option. Okay. If you sell a naked call option, you have unlimited risk because theoretically a stock can go to infinity. Okay. So if you don't have a hedge against that, like a covered call, like a stock position or another call against that, your margin requirement, your maintenance that your brokerage firm is going to charge you is going to be astronomical. Now, you still have unlimited risk if you write or sell a naked put by itself, but that risk is only down to zero, right? Because the stock can't go below zero like oil futures did at the beginning of COVID. So when you hear people say, oh, writing an option doesn't have unlimited risk, especially on the put side, theoretically they're correct because you know what that risk would be down to the stock being zero. Okay. Now, on the upside of buying a naked call option, you theoretically have unlimited profit potential. For the same reason that you would have unlimited risk selling, stock can theoretically just keep going higher and higher and higher and higher, and your call option will just keep getting more expensive. And if you buy a put option, if you have a naked put option, you have unlimited profit potential down to the stock being zero. So your clearing firms, your brokerage firms, brokerage firms, they'll allow you to buy naked options. Okay? They will allow you to buy naked options, no issue whatsoever. They more than likely will not allow you, unless you have level 3 or above, and then certain maintenance, certain margin in your account, will more than likely not allow you to sell a naked option. Okay? So what is an option spread? Well, option spreads give you a massive amount of leverage. Massive, massive amount of leverage. Okay, how so? Let's go through an example here. Somebody put a stock in the chat, and let's look at something live here. And we will compare a naked option versus a spread. And you will see the power of leverage, how that comes in using spreads. Also allows you to manage your risk while still maximizing your profitability. Okay, Okta, David, you were the first one. We are going to look at Okta. And you know what? Let's do it with, hang on, let me get some of this off the screen there. Let's do it looking at our current position that we have. Okay, so our position is, why isn't that popping up here? Hang on. We are short the June 6th, 117. And actually, let's start there. Let's start there. Okay, let's say you had just sold the June 6th, 117 call. As far, it's what, $9, $10 out of the money. Okay, maybe someone's looking at that and says, it can't get there. It's beyond the expected move. It can't get there. You're collecting 30 cents, which to me, that would be just insane to sell that option naked. But if you did, your P&L would look something like this. And this is where that unlimited risk comes in to the equation. The higher the stock goes, you're like being short naked stock there, right? At the 117 level. Once you hit 117, and what I have up here now is at expiration, that call becomes like a naked short stock position. And all you can gain, all you can make from selling a naked option or from selling an option, call or put, is the premium you have collected. Okay? So this is what your P&L would look like. You do that, you put that into your trading platform. Your margin is going through the roof. Your brokerage firm is not going to like it. In fact, those of you who are on the ability to go on a sim platform, go ahead, put in a naked call option and see what that margin would be. Now, before we go into how we might spread that off, let's just look at, instead of being short this call, let's just pretend we were short the put instead. We are going to see essentially a mirror image of that P&L with the maximum loss being down at 0. Okay, so the profitability, again, up here, all you can make is what you sell that option for. The lower and the lower and the lower and lower the stock goes, the worse off it is going to be. Okay, so I am never, ever opposed to selling options. We sell options when they get expensive, when implied volatility is expensive, or we sell options against buying, like in the case of Okta, a different option, maybe with a different expiration. That's fine. So I am never opposed to selling an option as long as I have it covered. Okay, so now let's take a look at, let's do something with just a plain vertical spread rather than like in our Okta position where we have a diagonal, two different expirations. So the next one, Robert, you were the next one on the list. You wanted to look at Oracle. Okay, Robert, are you bullish or bearish Oracle? It doesn't really matter. I just want to use it for example purposes right now. You bullish or bearish Oracle? Okay, there's no right or wrong answer here. We're just doing this for an example. Here's a chart on Oracle. You are bullish. Okay, so let's say for example purposes, okay, and let's say you're even going to use still calculating the expected move to figure out which option you might want to buy. So right now the stock is 162.5. If we were to go out to regular June expiration, we can see the expected move there is about 16 bucks. Okay, does everybody see that? I want to make sure everybody sees that. And yes, please smash the like button. Smash away, folks. Does everybody see the, okay, great. So, great. You might look at that and say, all right, stock's 162.5, $16 expected move. 178-ish is my target. So maybe you go out and you buy the 170 call. Okay, and that 170 call cost you $5. Okay, everybody see that? So you buy one call, your investment is $500 to own stock at 170. Okay, does everybody see that? So let's say, okay, let's say you have a $25,000 account, okay, and you are allocating 2% per trade. Okay, everybody with me? Okay, great. You would be able to buy one call because your allocation from a dollar standpoint would be $500, and that's exactly what this call costs. So you would buy one call. Okay, and if you bought one of those calls, your risk is $500. Your potential reward, unlimited. We know that it is unlimited. Okay, but let's say that we are using that expected move. Okay, we're using that expected move. And let's say the stock goes to the expected move range, which was like what, 178-ish, guys? Was it 178.5? Okay, if it's there at expiration, and I'll put this in right here, your position on one call would make you basically $3.50. How do we get that? Well, if you paid $5 and at expiration the stock is 178.5, that call is going to be worth $8.50. Your profit is $3.50 or $350. Your maximum loss is what you paid that $5. Everybody with me? Okay, great. So, okay, not horrendous. Certainly, if the stock goes higher and higher and higher, you're going to make more. Now, let's compare that to trading a spread. And we'll leave the buy option, same buy option, the 170 call. But instead of just doing that outright, let's say we sell the 177.5, which is closest to where that expected move was going to be. Okay, now this is going to cost us just over $2. Okay, let's call it $2.20. Robert, it's actually the other way around. Your reward on that at the expected move is 3.5 divided by 5. But your reward to risk is theoretically unlimited. Obviously, the higher the stock goes. But we were just using the expected move of 178 as the basis. Okay, so now this spread cost you $2.20. Okay, well, you can do 2 of those. If your allocation was $500, okay, you would do 2 of these spreads, which would cost you $440. You could do 3, go over your allocation a little bit, but let's stay conservative and let's say you're only going to do 2 spreads. Okay? If you do 2 of those, your cost is $440. Once again, just like in the naked option example, here we know what our risk is. Our risk is what we pay for this spread. So things go south, things go against us. Our risk is $440 here. Okay, everybody with me? Now, let's measure the leverage. Okay, this is where trading option spreads becomes so beneficial. The amount of leverage that you get. What do I mean by that? If we have this position and the stock goes to the same exact range, 178, as in the naked call, okay, what is that spread going to be worth at expiration? So the same $8 that the 170 call would have been worth at 178, what will this spread be worth at 178 at expiration? Okay. I love that we are going through this because a light bulb's going to come on for a bunch of you. Let me ask another. There we go, RDB. What is the maximum amount a vertical spread can ever be worth? It's the difference between the strikes, right? So Robert DB and Carlos, your answer of 750, because that is the width, the difference between the spread there. Whether the stock goes to 178 or 200 or 1,000, this can never be worth more than 750. Okay? Does everybody understand that? I think you do. So if we get to the exact same stock price at expiration, 178, this spread is worth 750. Well, we paid $440 because remember we bought 2 spreads, $2.20 each. We're now going to have a value at expiration of $1,500. 750 times 2. You will now have a profit of over $1,000, $1,060. So your reward to risk here, because of the leverage, went from less than 1-to-1. I know Robert and Bear, you had posted up here, was about 0.7 to 1 before, right? Okay. You now have about 2.5 to 1 reward to risk. You actually have less risk because in this instance, you only have $440 at risk. The other one, you had $5 at risk. John, that's a great comment. So John said, I never see the full spread realized when the stock price hits or exceeds the short strike. That's because of, you're right, the extrinsic value, the time value. These values, like when we go through those P&L spreadsheet analysis, on the Excel spreadsheets, we're always doing that with the value of the options at expiration. So the full value will never hit until at expiration. Okay. Now, you can see pretty plainly here in this example that buying this call spread would have been way better off than just buying the naked call if the stock went to the same price at 178. Does everybody get that? Everybody understand that? Because there's always a reason why one scenario offers you a better outcome or more, or in this case, better reward to risk, more bang for your buck than the first outcome. But there's always a give and take, right? We always talk about that. If someone's going to give us something, we're never getting anything for free. It is always a give and take. What is the drawback? What is the take in this instance? We know that if we go to 178 here, boy, we are way far better off trading this spread. But where is the drawback? Correct, Patrick, very good. Our profit is limited. This is it. That is the most we can make. Exactly, Steve. No matter, even though we have a bullish position on here, no matter if the stock went here or 200 or 1,000, that is all we could make. Defined reward, exactly, Robert. As opposed to, let's say the stock went to 190, okay? What happens if the stock goes to 190? Well, at 190, our naked call would be worth $2,000, less our $500 investment. We would make $1,500. Does everybody see that? Okay, now what about 190 if we had traded the spread? Well, at 190 trading the spread, we know the max this could ever be worth is 750. Times 2 is the 1,500 we went through before, less our $440 investment. We're still maxed out at 1060. So what you are potentially giving back is that upside opportunity. But for that upside, giving back that upside opportunity, if you are using the probabilities, using the math and the statistics to your advantage by using the expected move, you will get a far superior return. If you have an outsized move here, that's where it would hurt you a little bit. You're still going to have a great trade, but that's where that drawback is a little bit. This is the leverage spreads give you. Okay? And knowing and understanding and utilizing the expected move to your advantage rather than just saying, boy, I'm going to buy this call or I'm going to buy this put because I think the stock is going up or down without really knowing statistically from a probability standpoint what the market is pricing in, you're just kind of winging it. You're just kind of winging it. So, again, for me, I will rarely ever trade a naked option. Sometimes, as you all know, sometimes we will go out and buy an option with the premise that we're going to sell something down the road against it. But we will never, ever, ever sell an option first and have that unlimited naked risk. Even if we had the intent of buying something against it further on down the line as our hedge, we would never have that naked option on its own, that naked short option. Everybody cool with that? And I know we're all adults here, so we can put this on here. Hulk says everybody get naked. It's a good thing there's no cameras here for anybody. Let's just get that word up in the chat. Any questions? What do I got here? Any questions on the leverage side of things, on the reward, the risk, benefits, drawbacks? Remember, guys, trading is about probabilities. Okay. Sometimes, just like with anything, the probabilities don't happen. Over the long run, they do, which is why we adhere to that. And, there's obviously going to be situations that you're going to say, oh man, what if, right? Or shoulda, coulda, woulda. Man, if we had only bought this call and not sold the one against it, right? Look at what these profits would have been. William, $5, $7.50, $10. The reason that I typically will use those size spreads is twofold. Okay. One, we always, regardless of the width of the spread, whether it's $1 wide, $2.50 wide, whatever it is, we always measure how good the opportunity is based on reward to risk. But number two, okay, we could put out 20, 30, 40, $50 wide spreads if you want. The cost, the hard dollar cost, is obviously going to be much more expensive. The reward to risk may be really good, but if we put out a spread that, let's say, costs $6, $7, $12, how many of you would actually trade that, right? I'm assuming that most of your allocations on a trade, probably not more than $1,000. Maybe some cases it's a little bit more, right? So if we put out a signal that was an expensive trade, that's going to limit the amount you could do. That's going to be really limit the amount of people that can participate in that. Does that make sense to you? Thank you, Brad. And hindsight is always 2020. William, does that make sense? Does everybody understand that? Right? I don't care how wide something is, as long as my reward to risk based on the expected move is where I need to get it. Because if I'm using a tighter spread that costs less, I'm going to be able to do more of them. Right? Which will make up for the wider spreads where I can only do maybe one, or maybe it would actually. the trade. Not that I'm aware of, John. Not that I'm aware of. I'm sure somewhere along the line, somebody can write an algo for that. Would a 0 DTE naked put have the same leverage requirement as any other naked put? On the long or the short side, Justin? If you're buying or selling it. And I believe the wheel is closed. Yes, it is. Okay, so Justin, yeah, you're going to have the same margin, right? That margin is going to still be whatever that move could be down to zero. Even though it's a condensed time frame, whether it's 2 hours, 4 hours, if you're looking at a 0 DTE, right? The bottom line is the risk is whether it's, God forbid the S&Ps, it's not going to go to zero, but yes. Now, the brokerage firms may treat it a little differently just because of the time sensitivity to it. But the bottom line is that asset can still go to zero. All right. Let's get to Z Wheel. Ooh, we got more people on here than yesterday. That is good. All right. Let's give it a whirl here, guys. Gals. Are we going to be Kevin, or Mike? It looks like it's a Kevin, or Mike show today, and it is Kevin. You were here earlier. You were answering questions earlier. Are you still here, Kevin? Oh, Kevin, are you here? I am getting anxious to spin again, as is everybody else here. If you are not here, oh boy. Oh boy. It's a congrats to Kevin, but is Kevin here? Ah, Kevin, you made it just in time. So, Julia, moving forward, what you need to do is when I put this screen up during the presentation, there's going to be a different word on here every day. You just have to type it into the chat, and then it will automatically go on to the wheel. Kevin, you got the email to send to me? You know the email address to give me all your vital statistics? Emperor's New Clothes. But thank you for being here today, Julia. Tomorrow we'll do the same thing. As soon as we put whatever word that word of the day is, just put your name in the chat and you're in. All right, everybody. Truly appreciate it. We'll see what the market does the rest of the day. It's actually really, really calm. Volume is pretty low today. And what we will be looking at is actually there's big inflation data tomorrow. We get PCE data tomorrow. And obviously there's going to be lots of news flow on the tariff front as well. Oh, Julia, that's so nice. I would love for you to win another one. That would be great. All right, everybody. We will see you tomorrow. I appreciate everybody being here. Thank you. This short week. I can't believe it's Thursday already. Seemed like it was Wednesday. So, hey, you too, Brian. What's up, man? Haven't seen you in a while. Robert, always have the hits coming. Love it, Robert. All right, guys. Have a wonderful day. We will see you later. Thanks so much.